Hi, Mitch Irwin with Bell Bank Mortgage. Today I want to talk about refinancing, specifically the difference between a cash out versus an equity buyout refinance. A lot of people call me up, say, yep, I'm getting divorced, I need to cash out and pay out my ex-spouse. Yes, on a common sense or a very conversational perspective, I understand what they mean. That's what people think. That's what a lot of lenders and loan officers even interpret that transaction as. The reality is, it's not truly treated as a cash out. It can be treated as an equity buyout. And if you're only paying off an ex-spouse and not paying off other stuff, then it's treated as a rate and term refinance. The borrower gets a better interest rate, and they can go to a higher loan to value than what normal cash out financing allows for. A true cash out, if you're paying off credit cards, auto loans, attorney's fees, things like that, is going to be limited to 80%, and it's going to be a little higher interest rate than just a regular refi. But if you state that the money that's owed to the vacating spouse as a lien in the homestead section, meaning subject to a lien in favor of so-and-so for $50,000, the home at XYZ legal description is awarded to the staying spouse, that loan can be treated as an equity buyout. So the decree language matters. Try to make sure you don't do the cash equalizer at the very bottom of the divorce decree without any hooking to the homestead. Make sure you involve some type of lien language. But if you do it that way, it can be treated as a rate and term refi, and then they're going to have a much better loan. An example would be if it's a $400,000 house, maybe they owe $300,000 right now, there's $100,000 of equity and they're going to split that. That means $50,000 is owed to the vacating spouse. 300 plus 50 plus, add 6, 7, 8, whatever it is for closing costs and escrow, means that borrower needs a loan for about $357,000. Now, if you remember, some lenders will tell you that they can't do that loan because its cash out is limited to 80, which would be $320,000. But if they know a lot about divorce, they'll say, yeah, that loan could technically go up to $380,000 and it can get done because that'd be the 95% financing. So they can do it, buy that spouse out, and do this loan. It's $357,000. That's probably 89, 87% off the top of my head. It's less than 90. It's a rate and term refi. There will be some mortgage insurance, but you can get that loan closed, and it's going to be a better interest rate than in a cash out refi. So my point is, work with a lender that understands the difference between these two, how to structure the divorce decree language so that the borrower can get the loan that they want, meaning one loan, one payment. Otherwise, you're going to have to offset that buyout with some other assets, or they're going to have to take a second, or the outbound spouse simply won't get all their money. So if they do it the right way, they can get all their money owed to their ex, they get all their money in hand, and they get one loan, one interest rate, one payment. Thanks. I'm happy to answer any questions if you have specific conversations, specific clients you want to go through. Thanks. Have a great day.